Good afternoon. My name is Alexandre Delonchamp, and I'm a press officer with the Banque du Canada. I'll be moderating this afternoon's press conference. Governor Poloz will be pleased to take questions for about 20 minutes. Before asking your questions, kindly state your name and affiliation. Please use the wireless microphone as we're webcasting this press conference. If you raise your hand, my colleague will bring the microphone to you. Please keep it to one question and a quick follow-up to ensure that we give everyone a chance, and then we'll see how much time left we have for a second round. The Governor will be happy to answer questions in both official languages. Avant de poser une question, je vous prierai de vous identifier. Je vous demanderai également d'utiliser un micro sans fil. Libre à vous de poser vos questions dans la langue officielle de votre choix. Governor?
Hi, Governor. Hello? Hi, Governor.
Got it.
David George, your Wall Street Journal. Just to go back to last week's NPR, the Banque du Canada decided to use spot prices for its oil forecast. Can you explain why exactly the bank switched from using the spot price from the future price?
Well, sure. This is a pretty technical question, but it is that new research shows pretty clearly that, believe it or not, the current price for oil is a better predictor of the future price of oil than the futures curve is. That's another way of saying that it's really hard to forecast oil prices. In the past, we've used the futures curve as a fairly, ordinary kind of an assumption, if you like. It's not like an actual forecast, but it's neutral. So we switched to the spot price given that research, and at the same time offered up analysis around what does a shock to the oil price do to our policy questions. How does it affect the confidence intervals around our forecast, broadly speaking. So that to me is more informative. It goes along with my own thinking about how policy really is more of a risk management exercise than a pinpoint engineering problem. It also is more consistent with the working assumption we use for the dollar, which is we just take the recent value and we assume it will be the same for our forecast. And so oil prices being a significant factor in exchange rate movements, that increases the internal consistency of those assumptions.
And in a quick follow-up here, the next rate move, is it more likely to be a rate hike or a rate cut?
Well, at this time, we're expressing true neutrality on that question. I want to be clear that the outlook as we have it is that over the next couple of years, a little bit, about almost exactly 2 years from now, our modeling suggests that inflation could get back to about 2%. That's assume all the other things that we've got in there happen, which includes the rebound in exports. There's a great deal of uncertainty around that outlook, as we've expressed clearly today and in the past. Our models have not done a good job of explaining exports for the last almost 2 years. And so we've dug deeply into that and discovered that there's reason for hope, but it leaves about half of our export volumes bearing the weight of this concern, if you like. So that's all to say that there's too much uncertainty around that for us to be saying one way or the other to your question. So if for example, the export outlook fails to show up as we've built in there, as we're expecting, then higher inflation rates we have on total inflation will simply go away, and we'll be back down to around 2%. So excuse me, 1%, which is where underlying inflation is at this time. So getting it up means closing the gap. Closing the gap means it's got to happen through the external drivers. We simply can't close the gap with housing or consumption or those things. It's not sustainable.
Hello, is this on? I'm Joanne Paulson. I'm with the Western Producer, so obviously I have an interest in agriculture here. Mm-hmm. You were discussing that you were looking at these subsectors, and you did briefly touch on food and beverages, but I'm wondering if you sort of dug down into the raw commodity piece, which of course is what we're very interested in out here.
Yes. When we talk about food and beverages, I think it's a category called food, beverage, and tobacco. is one of those 31 categories. That, of course, covers a lot. So we do know, for instance, that last year we had this bumper crop in many grains and other products, which are stockpiled, and we expect exports to be stronger this year because the logistical constraints around that almost for sure have to ease up with the passage of time and as the winter is finally over. So that's, if you like, that's more of a mechanical thing in the forecast as opposed to whether or not they've been tracking. And so in general, we see that food, beverage, and tobacco have been tracking their driver pretty well. We're comparing that to demand, in particular in the U.S. market. So every reason to believe then that as the U.S. market continues to gather momentum, so will those export categories. So that's the premise that's based on that. The ones that we're most concerned about are the ones that have been losing ground relative to their drivers for a longer time. So those are where the competitiveness challenges are greater. And I draw your attention to this backgrounder that we've posted today. And so those are cases where it's going to take more work for the competitiveness challenges to be overcome and for those sectors to gather more momentum. And so I think there too we need to be patient. It's probably the sectors where we've lost more exporting firms during the downturn, and it's going to take longer time to rebuild those firms or have brand new firms, if you like, come into the sector.
I guess I'm wondering if there's some concern about us losing markets due to the transportation bottleneck, or indeed if you have an opinion on
Well, there are all kinds of risks in the world of exporting, which, and you've named one, but there are many others. It's simply not a case of just selling something and having it delivered. There's a lot more that goes into exporting. Very few people seem to appreciate it. They think of it as a theoretical thing where one country trades with another, but actually it's two people trading with one another, and lots of logistics have to happen in between. And so that would be one thing, that logistical issues, if they were long-term in nature, that could cause you to lose a contract. But at the same time, we know it's fundamentally a commodity business is such that people need to buy the commodity, and so their relationships help you, right? The relationships that are built up over the years, so that's a positive, which can then be, if you like, be a mitigant to this problem that may arise that's short term. So it's all about whether they're long-lasting or short-term, and we have every reason to hope that those logistical issues are on the mend as we sit here. So I'm optimistic about that.
Hi there, Rebecca Penty with Bloomberg News.
Hi
Thanks
there.
for taking my question. You mentioned industries that are underperforming. I'm just wondering, in the discussion paper that you guys had along with the speech, it showed that 2/3 of manufacturing industries have been underperforming. So I'm just wondering, does that undermine your hopes for a pickup in business spending?
You're right that what it does is it puts more questions around it, and it's exactly the story all along, which we're becoming more and more confident in with this extra research, is that the downturn that we went through wasn't just a matter of companies cutting back on production and then waiting for the recovery to come and then putting it back. The story is more a case where a number of companies simply couldn't last, and so they disappeared and the jobs with them. So when the recovery comes, the company's not there to put production back into the system. And the most of this damage was in the manufacturing sector. If you like, it's more like a post-crisis repair job for the economy as opposed to a classic textbook recovery. And frankly, we don't have models for that. We're just watching it happen. And as I said, the ingredients are all present. And so what you need is for there to be sufficient confidence that they will be maintained and that companies will feel comfortable laying out the investments required to re-engage or expand their capacity, or in some cases create a brand new business. All those things are riskier than the simple task of re-expanding after you've cut back during a recession. And so with confidence levels not back to normal, it's understandable that this process is taking longer. We don't really have a prediction for how long it takes, but from the conversations we're having, we're becoming more encouraged through time.
Just a quick follow-up. You kind of touched on this, but I'm going to ask it and blame my colleagues in Ottawa for the question. But you've been forecasting stronger exports and business spending for about a year now.
Yes.
And just wondering, at what point does the bank risk losing credibility because it hasn't happened?
Well, I guess I would say we're not alone in this. We are actually trying to forecast in an environment that we've never ever faced before. And so we do our very best, and we supplement the use of our models with things like we're showing you today, a more in-depth analysis of or granular analysis of where things are and where the dynamics are reassuring and where they're not. So that helps us feel more comfortable that the assumptions we're putting into our outlook are coherent with what business is actually thinking. That's supplemented by lots of conversations, my series of roundtables across the country, and of course our own surveys, which are in-depth interviews for a wide swath of companies across the country, and not just us. The CFIB survey is out today. It's a very meaningful survey, very large sample. It's a very sensitive survey, and it's showing some of these same sorts of signs of encouragement. So all that to say that I can't make excuses. It's just that we simply can't rely on forecasting in an environment where so many things have changed. The models are based on history. The history has substantially changed because of what we've been through. So we'll continue to do our very best, and we do think that all of the ingredients are present for this recovery in exporting, and furthermore that capacity utilization is quite high, so that means as soon as companies are locking in those export orders, they will need to invest in order to actually bring about the supply. So we're comfortable that the sequence will happen, and you're right, the timing has been difficult to predict and remains a risky forecast. That's why we say that our forecast for rising underlying inflation hinges critically on this forecast. It's not in the numbers yet. It's a forecast.
Jennifer Graham with the Canadian Press. Wanted to ask you about the interest rates. You seem to suggest that Canadians shouldn't have to worry about them going up for, at least substantially, for some time to come, which seems to be a slight shift away from what the bank has warned before about Canadians overextending themselves because the rates would have to go up eventually. So is there a concern, or what is the level of concern, that when Canadians hear that, they could still be spending perhaps more than they should be over the next couple of years, because now you've said, you've got some time?
Well, as we've described it, the zone within which we make these policy decisions is a risk management zone, not a precise engineering question. And the things we're trading off there are the risks to overextension, as you've called it, or what we call household imbalances, becoming worse, versus the risk that inflation, through some surprise, will be even further below target. So the trade-off between those two things is what we're trying to balance in this situation. We're saying that our best analysis is that it will be at least a couple of years before inflation can get back up to its 2% target. So we know that there's this prolonged window during which interest rates, are much less likely to rise than if everything were behaving according to our old models. The world just isn't. But at the same time, we have this overlay, which I described in the Halifax speech, which is about how our demographics are shifting. The baby boom retirement wave has begun. And what that does is it causes our potential output to gradually work its way down towards around 2% as opposed to something higher. And as that goes down, what happens is that what we call the equilibrium real rate of interest is likely to be lower. And this is not just us, this is for the world. That's why I said in the speech it's a growing consensus. It's something that many central bankers are starting to talk about, because we've been in this for 5 years, and the longer we're in it, the more we come to realize that the thing we call home looks different today than we thought a few years ago. Demographics are totally predictable. Everybody gets a year older every year, so it sounds like you shouldn't need a really fancy model for that. But actually, it's just more like a long-term anchor for the economy, and that suggests that as we get back to normal, that new normal will be different for those reasons. And one of the implications is that interest rates are unlikely to go up as high as we used to think of them as normal. And that's one reason. And the other one is that the economy, having been in a low interest rate space for such a long time, we do get accumulation of indebtedness, as you described. And the economy therefore becomes more sensitive, or the movements in interest rates have a larger impact on people than they would have in the past. So for those two reasons, I'm suggesting that as we get back home, people should be thinking of interest rates being lower than they used to think of them. Does that mean that they'll go out and borrow more? It could, but I really think that what we're observing is a high level of self-responsibility through this. There's all kinds of anecdotal evidence that people are choosing to buy less house than they qualify for because they don't want to overextend themselves, that our banks are underwriting very carefully, making sure that people can service their debt even if interest rates go up before they renew, those kinds of things. So with all that in the mix, I'm comfortable that this risk is not outsized.
And sorry, speaking of people getting older, the announcement today regarding pension reform, the possibility of a sustainable, flexible program the government announced, talking about more of a balance between employers and employees. I guess I'm just looking for your overall thoughts on the idea itself.
Well, I think it's a positive step. It's, of course, an announcement of a consultation process, so it's less than an announcement per se. And I think it's a positive consultation process. And one of the things that we deal with in this situation is uncertainty, and it has many sources. And one of those, of course, is people think about that longer-term future and whether they have a secure future. Pensions figure prominently in that. And so I think if we're able to bring more ideas and more flexibility to the table, that will be a positive thing. As to the actual substance, I have no comment at this stage, and that's really just very early days for that consultation.
Thank you.
Are we done?